The situation on the border of Ukraine and Russia is certainly unfortunate, and it is unfolding even as we speak. But an outcome of that geopolitical tension is that global equity markets were roiled, and you had safe haven demand push up gold prices in a big way. We're going to be talking about gold and how you should approach it, whether you should increase your allocation to gold in the near term to maybe hedge against a loss in your equity portfolio. Joining me to talk about the factors that are affecting gold right now is Navneet Damani, the Senior Vice President, Commodity and Currency Research at Motilal Oswal Financial Services. Thank you so much, Navneet, for taking the time. A lot is happening right now and several factors to talk about, but how would you describe the most recent moves in gold? How do they fit into your broad expectations as to how this commodity is going to move?
Well, hi. Gold has been a flavor for the bulls for quite some time now. I guess let us go back to 2019, where gold delivered about over 20% return. In 2020, again over 20% return. In 2021, however, trading was a little lackluster after a couple of bull years, and we saw about 4 to 5% of negative returns. And finally, 2022 seems to be catching up for all the losses that we incurred in 2021. So our stance at Motilal Oswal have been pretty bullish on gold for some time now, and we believe that the macro backdrop was already getting set, say probably for the year and a half, and finally the much needed trigger or thrust has come in from the Ukraine-Russia crisis and US-Iran crisis, which is kind of unfolding at present.
Okay, I want to talk about how gold prices normally move. Now, on the one hand, before this crisis in Ukraine erupted, there was a conversation about inflation being sticky or inflation being high in the United States, and that was putting upward pressure on gold prices, right? But at the same time, there was the expectation that bond yields would go up, and generally those bond yields and gold prices don't move in tandem. They move in an opposite manner, don't they? So how is that panning out, assuming that this Ukraine crisis is something that blows over in the near term?
Well, Ukraine-Russia crisis is just adding to the risk premium, or probably I would say the short-term impetus. The medium-term picture, as previously told, has been set up by higher inflation, weaker set of data points coming in from some of the nations, and a sharp recovery in US economy. So whenever US economy recovers very sharply, we see that the dollar index strengthens, and that kind of has a weak impact on gold. But in the longer run, both go hands in hand. So that is where we see that higher inflation and a stronger economy is likely to fuel up further demand. To top it up, inflation is led by 50% of the inflation globally at this point is led by energy prices. By energy, I mean crude oil, electricity, coal, and lumber prices. And all these prices do not see any kind of respite in the near future as well. So if at all we believe that these prices are here to stay or maybe correct by 10% or so, inflation is not going to be impacted much, and it is going to stay at elevated levels, much above the RBI comfort level or the Fed's comfort level. And most of the central banks have very few ammunitions to control inflation. One of the bigger ammunition that I believe is rising interest rates, where most of them have started to talk about tweaking their interest rate. It is believed that Fed could hike rates by about 2 to 3 times in 2022 and another 3 to 4 times in 2023. So the rate bottoming out scenario or the yields flattening out scenario is kind of done in the last couple of years, and we may say rate hike rising once again. As you rightly pointed out, when rates start to rise, it is negative for gold. But we believe that it will take its own sweet time to bite into the gold price at this point in time. Also, over the last couple of years, we were witnessing a lot of money which was coming into gold, going into riskier assets like bitcoins and equities. Now that equities have corrected or started to lose steam, and bitcoins have corrected, or not just bitcoin but cryptocurrencies have started to correct very sharply from highs, almost half of what they are. This money is likely to come back towards gold, which is likely to drive prices higher. So we believe that all in all, over the next 6 to 12 months, the picture looks quite strong. and say another 8 to 10% gains from here on also looks pretty much on cards.
There is an expectation that they're going to go higher now. I want to understand from you, based on your experience, of how the yellow metal has moved in the face of geopolitical crises. What is that experience, and where do you expect gold prices to go from this point on?
Well, let us take the last two crises. We saw one of the crises coming in the 90s where gold prices moved from about $300, $350 to upwards of $900. Then the second crisis came in 2007, and that was financial crisis, which led gold prices rally from 600 odd dollars to $1,920. That is three times of what they were in a span of 5 years. Now, after that, prices did come to $1,000 levels and now have bounced back towards 1,950 odd levels. We strongly believe that that kind of move will not be witnessed in the next 3 4 years, but definitely another 10 to 15% upside for 2021 and another 10% 22 and another 10% upside for 23 is pretty much on cards. We believe that on the domestic front, prices are likely to trade upwards of 58,000 odd, and on the COMEX front, maybe 2350, $2,400 could be on cards. However, one has to not forget that the trajectory of rates have now started to plateau and will start to reverse. So it is not going to be a one-side rally. There will be bouts of correction in between, and if the world scenario moves much faster than what the retailers are expecting in terms of hiking rates, then there could be a scenario that what we anticipate might take a little longer than what we expect, because if that happens, then there or probably three rate hike scenario converts into a 5 6 rate hike scenario in 2022 odd, then we might see that the term or the bullishness in gold could start to fade off, and we might see gold plateauing around say $2,000 as well.
Okay, that covers gold, Navneet. What about silver? Do you think that there is a strategy to be had? There is, of course, the opportunity here in India to consider a silver ETF as well. How do you see that metal moving? Because there's also the aspect of the electric mobility scenario and industrial growth that will affect silver prices, right?
Yes, definitely. Well, silver is looking much more interesting than what gold does, and we've seen silver actually benefits out of a dual personality where it is a mix between industrial metal at this point in time as well as a precious metals. So most of these industrial metals have given you about 120 to 140% returns in the last couple of years, and to a certain extent, they have become unviable for a lot of manufacturers. However, silver is up about 30-40% in the last 2 years, so it is still within the range of manufacturers to substitute some of these metals like nickel to some extent, to copper to some extent, and use silver because it's a better quality material and the prices have not run up as much as in case of the industrial metal. So there is a lot of substitution demand in photovoltaic, in electric charging points, in electric cabling, where we are witnessing silver demand rise very significantly. And to top it up, now that the gold rally is also started to bite in, then it is going to be positive for silver on both aspects. We expect that silver could give you better or maybe even 2x returns than what gold could give you. And we strongly believe that $30 followed by $34 could be on cards on the international front. On the domestic front, 80,000 is what we believe could be a 12-month target for silver, and will not be surprised if we see 2020 through 23 having silver prices upwards of 95,000 to a lakh rupees. As you mentioned, now a lot of retail participants were kind of very apprehensive about buying silver because one, there was a quality issue. Second, the bulkiness of the commodity. But now that ETFs are in place, there are certain ETFs which are already listed and many more in the pipeline. ETF could be a one good bet where you want to look to accumulate silver from probably a couple of years perspective, where they could get say about 30-35% returns in the next 2 years. And definitely I would like to highlight that it could give you better returns as compared to gold, but the volatility in silver is even higher as compared to gold. So one has to not forget that if you are a passive investor, then gold is something that you look at. If you can have that appetite to trade silver, then you need to have slightly more volatility in your portfolio.
Absolutely. There is a risk associated with higher returns. Thank you so much, Navneet, for taking the time. Appreciate it.
Thank you.